On July 27, 2026, the single most important endorsement in crypto regulatory history landed. Franklin Templeton, a firm that manages $1.8 trillion in assets, publicly called on the U.S. Senate to pass the Clarity Act. Not a crypto company. Not a lobbyist. A $1.8 trillion Wall Street giant. And their message was blunt: it's time to provide the industry the clarity it needs. By the end of this video, you'll understand why this changes everything and what happens next. Let's be clear about what just happened. Franklin Templeton didn't just express support. They issued a direct call to action to the United States Senate. The tweet went out at 2026 Universal Time Coordinated on July 27, 2026, and within minutes, every major crypto news outlet had picked it up. To put that number in perspective, $1.8 trillion is larger than the GDP of Canada. It's larger than the entire crypto market cap. This is not a small player dipping a toe in the water. This is a financial superpower going all in on regulatory reform. Before today, the Clarity Act was a political football. After today? It has the backing of one of the most respected names in global asset management. That changes the math in Washington. Franklin Templeton was founded in 1947. They've been managing money for 79 years. They operate in over 30 countries. And over the past 3 years, they've become arguably the most aggressive traditional finance player in the crypto space. In 2021, they launched the Benji Fund, the first US-registered mutual fund to use blockchain for transaction processing. In 2024, they launched EZBC, their spot Bitcoin ETF. In April 2026, they acquired 250 Digital Asset Management and created Franklin Crypto, a dedicated institutional crypto division. Their tokenized treasury AUM has crossed $2.5 billion, up 100% year-to-date. And just last week, they filed for 2 Bitcoin DRIP ETFs that would automatically convert stock dividends into Bitcoin. This is not a firm that's experimenting with crypto. This is a firm that has built an entire institutional infrastructure around it. The Clarity Act is a 616-page bill that does one thing above all else: it draws a clear line between the SEC and the CFTC over who regulates what in digital assets. Right now, the biggest problem in U.S. crypto regulation is jurisdictional ambiguity. Is a token a security? A commodity? Both? Neither? The Clarity Act answers that question. Under the bill, digital commodities like Bitcoin and Ethereum would fall under the CFTC. Investment assets, tokens that represent ownership or profit sharing, would fall under the SEC. Stablecoins get their own regulatory framework. The merged draft was released on July 22, 2026, combining the House-passed version with Senate amendments. It's the most comprehensive crypto market structure bill ever written. Here's where it gets complicated. The House passed the Clarity Act with a 294 to 134 bipartisan vote. But the Senate has been stalling for months. Chairman Tim Scott identified 3 issues on April 14: stablecoin yield language, DeFi provisions, and securing full Republican committee block. He said they were resolvable within 2 weeks. That deadline slipped. Then Senator Tom Tillis requested extra review time. The bill currently carries 36.5% yes support in the Senate. They need 60 votes to overcome the filibuster. That's a long way from 36.5%. The stakes could not be higher. Let's dig into what those 616 pages actually contain. The bill has 4 major components. First, market structure, clear definitions of digital commodities, investment assets, and who regulates them. Second, stablecoins, a federal framework for payment stablecoins with reserve requirements. Third, DeFi provisions, how decentralized protocols fit into the regulatory framework. Fourth, enforcement, new tools for the SEC and CFTC to go after bad actors. A new draft also includes provisions that would impose limits on Trump's crypto business interests, a political landmine that could complicate passage. Crypto PACs went 48-4-48 in the 2026 primary cycle. Over $100 million in lobbying spend. This is the most lobbied piece of financial legislation in history. The politics are brutal. Senate Majority Leader John Thune has indicated there aren't enough votes yet. The White House wants the bill passed. But the Senate calendar is running out. Here's the timeline. Motion to proceed, July 27 to 28. Floor debate, week of July 28. Floor vote, week of August 3. Deadline, August 7, when Congress leaves for summer recess. That's 10 days to get this done. If they miss the August 7 deadline, the bill doesn't come back until September at the earliest, and the odds of passage drop significantly. Nobody gets everything they want. That's the nature of compromise. What happens if the Clarity Act passes? The institutional floodgates open. Franklin Templeton Sandy Call published a paper arguing that agentic AI software that acts, pays, and decides on your behalf will run on crypto rails, not Wall Street ones. She projects AI agents will account for 15 to 25% of all U.S. e-commerce sales by 2030. If the Clarity Act passes, U.S.-based institutions can deploy capital with legal certainty. If it fails, that capital goes to Singapore, Dubai, and the EU, where regulatory frameworks already exist. The polymarket pricing currently puts 2026 enactment at 50 to 50 or lower. But Franklin Templeton's endorsement could shift those odds. Over the next 10 days, watch 3 things. 1. The motion to proceed on July 27 to 28. If that fails, the bill is dead until September. 2. Floor debate, where amendments will be offered and the real negotiations happen. 3. The final vote, expected the week of August 3.